While the stock market is riddled with uncertainty, certain tried and true principles can help investors boost their chances for long-term success. Some investors lock in profits by selling their appreciated investments while holding onto underperforming stocks they hope will rebound. But good stocks can climb further, and poor stocks risk zeroing out completely. Welcome to this investment channel. Watch till the end to know about 10 long-term investment strategies that work. Have a financial plan. A financial plan can help you figure out your risk tolerance at different points in your life as you move toward a clear retirement goal. Sticking with a sound plan can also help keep you from trying to time the market based on emotions and can help you stay disciplined, which is a key factor in long-term investing. If an investor is honest about what they want to accomplish at each phase of life, along with understanding their risk profile, the investment strategy will be designed to help them stay the course and remove the opportunity to chase investments based on emotional triggers, says Jack McGowan, CEO with 2 Point Capital Management. A financial plan will help you focus on the types of stocks and bonds in your portfolio and whether you opt for a traditional 60/40 portfolio or you adjust that mix. Start investing as early as possible. The longer money is invested, the more potential it has to grow. When you start early, not only do you get the compounding effects of the capital, but you also create the opportunity to buy at an average cost over time, says McGowan. Don't try to time the market. Time is your friend in the market over the long run, but you shouldn't try to time the market in the short term. It requires two decisions, when to get out and when to get back in, McGowan says. It's tough to get both right over time. Obsessing about getting out and back in at the right times can lead to missing out on big recovery days and can significantly lower returns for long-term investors, says Matthews. Sell a loser. There is no guarantee that a stock will rebound after a protracted decline, and it's important to be realistic about the prospect of poorly performing investments. And even though acknowledging losing stocks can psychologically signal failure, there is no shame in recognizing mistakes and selling off investments to stem the further loss. Don't sweat the small stuff. Rather than panic over an investment's short-term movements, it's better to track its big-picture trajectory. Have confidence in an investment's larger story and don't be swayed by short-term volatility. Don't overemphasize the few cents difference you might save from using a limit versus market order. Sure, active traders use minute-to-minute fluctuations to lock in gains, but long-term investors succeed based on periods of time lasting years or more. Don't chase a hot tip. Regardless of the source, never accept a stock tip as valid. Always do your own analysis of a company before investing your hard-earned money. Tips do sometimes pan out, depending upon the reliability of the source, but long-term success demands deep-dive research. Pick a strategy and stick with it. There are many ways to pick stocks, and it's important to stick with a single philosophy. Vacillating between different approaches effectively makes you a market timer, which is dangerous territory. Consider how noted investor Warren Buffett stuck to his value-oriented strategy and steered clear of the dot-com boom of the late 90s, consequently avoiding major losses when tech startups crashed. Don't overemphasize the P/E ratio. Investors often place great importance on price-earnings ratios, but placing too much emphasis on a single metric is ill-advised. P/E ratios are best used in conjunction with other analytical processes. Therefore, a low P/E ratio doesn't necessarily mean a security is undervalued, nor does a high P/E ratio necessarily mean a company is overvalued. Be open-minded. Many great companies are household names, but many good investments lack brand awareness. Furthermore, thousands of smaller companies have the potential to become the blue-chip names of tomorrow. In fact, small-cap stocks have historically shown greater returns than their large-cap counterparts. Resist the lure of penny stocks. Some mistakenly believe there's less to lose with low-priced stocks. But whether a $5 stock plunges to zero or a $75 stock does the same, you've lost 100% of your initial investment, so both stocks carry similar downside risks. Be concerned about taxes, but don't worry. Putting taxes above all else can cause investors to make misguided decisions. While tax implications are important, they are secondary to investing and securely growing your money. While you should strive to minimize tax liability, achieving high returns is the primary goal. Focus on the future and keep a long-term perspective. Investing requires making informed decisions based on things that have yet to happen. Past data can indicate things to come, but it's never guaranteed. In his 1989 book One Up on Wall Street, Peter Lynch stated, "If I'd bothered to ask myself, how can this stock possibly go higher, I would never have bought Subaru after it already had gone up 20-fold. But I checked the fundamentals, realized that Subaru was still cheap, bought the stock, and made 7-fold after that." It's important to invest based on future potential versus past performance. While large short-term profits can often entice market neophytes, long-term investing is essential to greater success. And while active trading, short-term trading can make money, this involves greater risk than buy-and-hold strategies. A digital wallet for all your Web3 needs. From crypto to NFTs and beyond, accessing a wealth of DeFi platforms is simpler than you might think. With OKX, a leading digital asset financial service provider, you can access world-class security as you trade and store assets. You can also connect existing wallets and win up to $10,000 when you complete a deposit of more than $50 through a crypto purchase, or top up within 30 days of registration. Learn more and sign up today. Don't forget to subscribe to this channel, like and share this video, and leave a comment below if you have any questions. Thank you for watching.